Are you an investor that is having a hard time earning serious money on the stock market? Are you stuck, overwhelmed by the never-ending waterfall of financial news and get-rich-quick schemes? Not sure what works and what doesn't? Well, fear not. You're in the right place, because this is the official Value Investing Bootcamp podcast. And now, to help you skyrocket your returns, here is your host, value investing expert Nick Krockman.
Hello everybody, welcome to the 18th episode of the Value Investing Bootcamp podcast. Thanks so much for tuning in again. As always, I'm your host Nick Krockman, and in the previous episode we talked about interest rates, growth rates and discount rates. I hope everything about that is clear. If not, shoot me an email with your questions, nick@valuespreadsheet.com, and I'll answer it for you. Or send me a tweet @valuesheet, and same thing, I'll answer it. I'll answer all your questions or comments. Today we have another interesting topic to cover. Many people ask me this question: when should I buy and when should I sell? Well, everyone knows the adagio which says, buy low, sell high. And that is exactly what I propose to you. Buy low, sell high. Warren Buffett said, be fearful when others are greedy and greedy when others are fearful. In other words, you should buy when people are very pessimistic, because this creates very low share prices, and sell when people are optimistic and stocks get hyped and overvalued. That's when you want to sell, because that's when you get the best price for your stocks. So that's the first thing I want to say. However, buying at a low price, it depends on several things. How low, for example, should your price be? We already discussed in previous episodes how you can calculate an estimate of the intrinsic value of a company, and that you can then compare the current stock price with that value and see whether it's cheap or not. The difference between your purchase price and the intrinsic value is called the margin of safety. And the further you buy below the intrinsic value, the bigger your margin of safety. And this margin of safety is a crucial aspect of value investing. Warren Buffett once called it the 3 most important words in investing. And that says a lot coming from his mouth. So why is it so important? Well, because a margin of safety actually creates room for error. That's one thing. So because we are working with imperfect information, we have to build in some room for error, because our estimates could be wrong. The company could not perform as well as we expect, but still we want to make money, or at least minimize the risk of losing money. And the only way to do this is to purchase at a price which is significantly lower than the intrinsic value of the company. That way for example, if you purchase $1 of value for 50 cents, then you have a big margin of safety, and your upside potential is high and your downside potential is relatively small, because you already purchased at such a low price. But even if the value of the company appears not to be $1 but just 70 cents, you still make 20 cents profit if you purchased it on 50 cents. So this is why intrinsic value and a margin of safety is so crucial. So how big should your margin of safety be? Well, I usually aim for a margin of safety between 50 and 100%. So this means that, just like in the example before, I would purchase a stock only if I expect an upside potential of between 50 and 100%. We also discussed in earlier episode that it can take up to several years before this value, this gap between price and value is finally closed. So if you have a 100% profit potential and it takes 5 years to get there, you're around 20% a year, which is perfect. And if it's quicker, you have even more per year, a better return per year. So that's what I would aim for. But maybe even more important is the fact when will you sell? Because yeah, sure, you can purchase at a great price, but when will you finally decide to sell? Because a stock can always go higher, and it is impossible to predict the future stock price movement. So how can you possibly know when to sell? Well, this is a question that I receive often, and actually the answer is pretty straightforward. As again, you just compare it to the intrinsic value that you calculated. So if the stock price comes near that value, it means that the stock is fairly valued. It's no longer undervalued, which means that it no longer has a lot of upside potential. Then you're better off selling and putting your money into a better opportunity, which is priced at much lower than your current holding. So sell when you find a better opportunity to put your money, a more attractive stock to put your money in, which has more upside potential left. That's one thing. Another thing is something can change. I mean, you purchase a company which is perfectly healthy, everything is going great, you get it at a nice price, and then something happens. I mean, sometimes short-term things happen, like a lawsuit or an investigation, which can push the price down to unreasonably low levels. But these are often short-term things. Once the lawsuit is over, the stock is fine again, and they probably have to pay a fine if they lose, but most of the time these fines are just, they can pay it and they have the money for it, so they pay it, they have a bit less profit that year, and then they move on. They keep going strong. But sometimes something fundamentally changes. Sometimes something happens with a company. They like a new competitor enters the market who just crushes their business model. What in this case, your initial thesis to buy this company no longer stands. It no longer holds because something fundamentally changed, and this might not necessarily mean that your thesis is wrong. I mean, sometimes you can still hold on to the company if it is still able to, push out a nice return. But sometimes these fundamental changes are so strong that you just are better off selling it and looking for better opportunities. So I hope this is clear, that you buy when prices are low. You buy at a significant discount to the intrinsic value. This is called the margin of safety, and the bigger the margin of safety, the safer you are and the more upside potential you have. And you sell whenever the stock price comes close to the intrinsic value, or when you find a better opportunity, or if something fundamentally changes with the company that you own. So that's all about when to buy and when to sell. In the next episode, we'll look into some portfolio management. So how should you diversify and how many stocks should you buy, things like that. So I'll see you in that episode, which will be the second to last episode of this podcast. I'm starting to get emotional. No, I'm still good, but I hope you're still enjoying it, and I'll see you in the next episode.
If you enjoyed today's show, head over to valueinvestingbootcamp.com to find out more on how you can invest like the pros, manage your own portfolio with confidence, and consistently earn mind-boggling returns on the stock market.